Welcome back to the Daily Crypto Roundup. Today we've got a packed episode because we're covering a market that is bouncing on the surface but still looks a lot more fragile underneath. We're going to break down why JPMorgan says crypto inflows slowed sharply in the first quarter, why Iran reportedly wants crypto-linked tolls for oil tankers moving through the Strait of Hormuz, why Bitcoin pushed back above $70,000 on ceasefire hopes, but the rally is already turning more cautious, why Polymarket traders still do not believe a quick Israel-Hezbollah ceasefire is likely, and finally why Polygon Labs is reportedly trying to raise up to $100 million to push harder into stablecoin payments and real-world financial infrastructure. The common thread through all of this is simple. Crypto is still reacting fast to headlines, but underneath those headlines, the market is trying to work out what is real strength, what is just relief, and where the next genuine growth is going to come from. Before we go any further, this episode is sponsored by Kraken. If you want a trusted place to buy and sell crypto, Kraken is one of the names we're happy to mention on this show. It has built a strong reputation over the years. It is used by millions globally, and if you want to check it out, use our Kraken link in the description and support the show at the same time. Now let's start with the broader market picture, because this is where the tone of today's episode really begins. One of the most important pieces of reporting we've seen is the claim from JPMorgan that crypto inflows slowed sharply in the first quarter. And that matters, because whenever inflows weaken, it tells you something about the conviction underneath price action. If fresh money is not arriving at the same pace, then the market becomes much more dependent on narrative, momentum, and a small group of buyers to keep prices afloat. In simple terms, fewer fresh buyers means less fuel. And when a market has less fuel, every rally has to work harder to sustain itself. That slowdown in inflows is important because it tells us something a lot of traders do not always want to hear. A market can still rise even while demand underneath it is getting patchier. Prices can hold up for a while because positioning changes, macro fear eases, or short covering kicks in. But if broad participation is weakening, then the rally becomes more fragile. It becomes easier for sentiment to swing. It becomes easier for one bad geopolitical development, one nasty macro print, or one wave of profit-taking to knock things backwards. That is where the Iran story comes in, because one of the biggest reasons crypto and broader risk assets got a lift today was the announcement of a 2-week ceasefire linked to the US and Iran standoff. Markets immediately liked that headline because it eased some of the worst-case fears around energy supply, inflation pressure, and a wider regional conflict. Oil prices dropped sharply, stocks pushed higher, and crypto joined the relief move. That is exactly the kind of macro shift Bitcoin tends to respond to when traders feel a key pressure point has temporarily cooled off. But the problem is that the market is not dealing with a clean peace agreement. It is dealing with a fragile pause. And that is a huge difference. Because at the same time as this ceasefire headline was driving relief across markets, reporting was also emerging that Iran wants crypto-linked tolls or digital payment-based fees for tankers transiting the Strait of Hormuz. That takes this from being a normal ceasefire story into something much stranger and much more politically charged. The Strait of Hormuz is not some side detail. It is one of the most important choke points in the global energy system. A huge share of the world's oil and gas trade passes through it. So whenever transit through Hormuz becomes uncertain, markets pay attention very quickly. What Iran appears to be doing here is not really a clean crypto adoption story. This is not the sort of thing where you say, look, countries are embracing blockchain and everything is going mainstream. This is much more about power, leverage, sanctions exposure, and control over a strategic route. Crypto in this context looks more like a payment rail that can operate where normal political and financial channels become awkward. That is why this story matters, but not in the way some people will try to frame it. It is not a simple bullish signal for digital assets. It is a sign that crypto is increasingly being dragged into areas where geopolitics, trade, and alternative settlement systems start colliding. That makes the headline dramatic. It also makes it dangerous to overread. Because if you take a step back, the market message here is not that risk has disappeared. It is that one specific part of the risk picture eased enough for traders to buy the dip. The bigger instability is still there. And that is exactly why Bitcoin's rally above $70,000 is being treated more cautiously than the headline number might suggest. Yes, getting back above that level matters psychologically. It shows buyers were willing to step back in once oil rolled over and ceasefire hopes improved. It shows that macro-sensitive money is still watching these geopolitical turns closely. And it shows Bitcoin can still respond aggressively when one of the market's biggest immediate fears starts to unwind. But there is a big difference between a relief rally and a conviction breakout. A relief rally happens when the market stops panicking. A conviction breakout happens when the market starts believing again. Those are not the same thing, and right now this looks much more like the first one. Why? Because the reasons for caution are obvious. The ceasefire is only temporary. Shipping through Hormuz is still not back to normal. Tankers are still facing uncertainty, extra controls, and a lot of caution from operators. Traders also know that even if direct US-Iran pressure cools for a moment, the wider region remains unstable. And when the wider region remains unstable, oil risk, inflation risk, and general macro nerves do not just disappear overnight. That brings us neatly to the Polymarket angle, because this is one of the clearest windows into how traders are actually thinking. Even after the Hormuz deal and the market bounce, Polymarket traders still do not appear to believe that a quick Israel-Hezbollah ceasefire is likely. That tells you the market is not treating this as a clean reset in Middle East risk. It is treating this as a narrower pause in one front of the conflict while another front remains highly uncertain. And that matters because markets are usually smarter when they refuse to fully trust the good news too quickly. If traders really believed the region was settling down fast, you would expect stronger confidence in the broader peace narrative. Instead, what you appear to have is a market saying, yes, the immediate panic around Hormuz has eased enough for a bounce, but no, we do not think the wider geopolitical picture is properly resolved. That is a much more sober read, and frankly, it probably makes more sense. So when you put the JPMorgan flow story next to the Bitcoin relief rally and then place the Polymarket skepticism on top of that, the picture becomes pretty clear. This market can still rally. It can still react positively to easing macro fear. But the base underneath it is not especially strong right now. Demand has weakened, confidence is selective, and traders are still quick to price in downside risk if the broader context turns ugly again. That is why today's move should be respected, but not blindly chased. Now let's turn to the fifth story, because in some ways it is the most strategic one of the lot. Polygon Labs is reportedly targeting up to $100 million in funding to accelerate its payments push. And to me, this is interesting because it points to where serious crypto infrastructure players think the next real growth lane could be. For a long time, a lot of altcoin stories were built around the same recycled ideas. Faster chain, cheaper fees, more scalable architecture, bigger ecosystem, more partnerships, better developer experience. And at some point, a lot of those narratives started blending together. Every chain was fast, every chain was cheap, every chain was supposedly building the future. But the market gradually got more selective, especially as capital got tighter and investors started asking harder questions about what these networks were actually doing in the real world. That is why Polygon leaning harder into payments matters. Because payments is one of the few areas in crypto that has a very obvious path to practical relevance. Stablecoins already have real utility. Cross-border movement of value is a real use case. Settlement infrastructure is a real use case. On-ramps, wallets, merchant tools, and programmable payments all live in a category that makes sense even to people who do not care about token speculation. So if Polygon is trying to become more deeply embedded in that layer, then it is not just trying to win another altcoin narrative. It is trying to move closer to real transaction flow. And that is a much more serious game. It also lines up with the wider theme running through today's roundup. The market is increasingly separating stories driven by short-term emotional relief from stories tied to long-term functional relevance. Bitcoin's bounce today is partly about emotion, positioning, and easing macro stress. Polygon's raise, if it is executed well, is about building a lane that might still matter even when the emotional swings calm down. That does not mean Polygon suddenly becomes a guaranteed winner, and it definitely does not mean every payments headline should be treated as instantly bullish for the token. A raise is not the same thing as success. Building payments infrastructure is expensive, competitive, and regulation-heavy. There are other chains, exchanges, fintech firms, and stablecoin players all chasing similar opportunities. So none of this is automatic. But strategically, it is the kind of direction that deserves respect. Because in a market where investors are getting more selective, the projects that move closer to real economic activity tend to stand out. And this is where the bigger message comes in. If you are trying to understand where crypto is going next, you cannot just watch price candles anymore. You have to watch what kind of activity the industry is organizing itself around. Are the strongest stories purely speculative? Or are more projects trying to align themselves with payments, stablecoins, tokenized assets, and infrastructure that can plug into the real economy? That shift matters. Because one of the biggest lessons from the last couple of years is that hype alone does not carry everything forever. At some point, the market starts asking what survives when the easy money goes away. And when you look across today's stories, that question is everywhere. JPMorgan's warning on inflows says broad demand is not as strong as it once was. The Iran and Hormuz stories say macro and geopolitical shocks can still swing everything very quickly. Bitcoin's push above 70,000 says traders will buy relief when fear cools off. Polymarket's skepticism says they still do not trust the wider peace narrative. So the takeaway for today is fairly straightforward. Respect the rally, but do not confuse relief with resolution. Bitcoin is stronger than it looked when panic was peaking, but the market underneath still has vulnerabilities. The geopolitical backdrop remains unstable. Investor demand has clearly become more selective. And the parts of crypto that look most interesting from here may not be the loudest or most speculative ones, but the ones building payment rails, stablecoin infrastructure, and systems that can still make sense outside of a pure bull market frenzy. Stay safe, stay ready, and as always, we will see you at the top.